Hey everyone, I'm Lynn. What if I told you there's one US stock this year that's seriously undervalued, arguably misunderstood by most investors, and could be a value opportunity people keep overlooking? Before you click away thinking this is hype, hear me out. In a market where AI stocks are running wild and investors are piling into the likes of Nvidia and Microsoft, PayPal looks more like a forgotten orphan than the global payments powerhouse it used to be, once a dominant force with over 400 million users worldwide, a company that helped define online payments, yet today its stock price has been chopped down repeatedly to a valuation that barely sits around 11 times earnings. Let that sink in. A technology giant with hundreds of millions of users, valued similarly to some old economy banks? That's not a small detail. Is PayPal broken? Has it lost all relevance? Or is something else going on? That's exactly what we're diving into today. I'm not going to waste your time with vague market sentiments or surface level talking points. We're going to unpack PayPal's story from four angles: its core business, its moat, its current valuation, and how AI could factor into its future. If you're watching this because you've been holding PayPal and are questioning your position, or you're thinking about bottom fishing around current levels, you need to stick with me till the end. By the time we're done, you'll have a clear answer on whether $55 PayPal is worth buying or holding. But before we begin, a quick note. Everything I cover here is based on publicly available data and my own research, and it reflects my personal view. This is not financial advice, and the markets carry risk, so tread carefully. Now let's get into it. What happened to PayPal's stock? Over the last year, PayPal dropped from around $90 down to about $55, a decline of roughly 37%. That's eye-catching, especially in a market that's generally rebounding strongly. If you opened PayPal's financials right now, your first reaction might be confusion. Revenue is growing, profits are growing, and the company is aggressively buying back shares. So why does the stock look like a beaten-down commodity play? To understand that, we need to face one hard truth. PayPal's problem isn't that it can't make money. It's that the market no longer values its way of making money. If we go back to 2010, PayPal's share price has lost about 80% of its value from its peak. For a company that once topped a $300 billion market cap, that's an enormous valuation decline. But there are four core reasons behind this dramatic downfall, and if you don't grasp them, PayPal's current 11 times PE multiple will always look inexplicable. Reason 1. Growth expectations have crashed. This is the most brutal point. Investors originally bought PayPal for growth. Back in the pre-COVID years, e-commerce was exploding. Digital payments were racing higher, and PayPal was positioned as the biggest beneficiary. Everyone treated it like the next Visa or MasterCard, a company that would ride the e-commerce wave forever. But after 2024, things changed. PayPal's growth decelerated into the single digits. User expansion slowed and transaction volume still rose, but not at breakneck speed anymore. The pandemic lift faded, and the market began reclassifying PayPal. Buyers shifted their label from high growth disruptor to mature cash flow business. Once that happens, valuation multiples compress because mature cash generators simply don't command the same price investors are willing to pay as growth stories. Reason 2. The payments landscape has become crowded. Another critical point that a lot of casual investors overlook: the payments industry today is nothing like it was 10 years ago. PayPal used to operate in a wide open field. Now it's a battlefield. On the consumer side, Apple Pay and Google Wallet have become the default digital payment methods on mobile devices. On the merchant side, platforms like Stripe and Adyen have rapidly gained share, offering flexible global payment systems with developer-friendly tools. PayPal today doesn't have a moat around an empty castle anymore. It's competing in a fully surrounded marketplace. Investors aren't questioning whether PayPal will survive. They're questioning whether it can grow faster than the competition, or even as fast. Once that expectation shifts to uncertainty, valuation falls. Reason 3. The investment narrative changed. Earlier, investors looked at raw metrics like active accounts and total transaction value. Now, Wall Street cares about metrics like transaction margins, free cash flow quality, and EPS composition. By those standards, PayPal is doing a solid job. Profit margins are improving, cash flow remains healthy, and the company is returning capital through buybacks and dividends. But here's the problem: those are mature company characteristics. They don't support high multiples. This is the classic story of a once high growth company evolving into a cash generator. That shift in narrative naturally trims valuation multiples. Reason 4: the market is obsessed with AI. This one might sting. Right now, capital is chasing AI, cloud, semiconductors, and space plays. Every headline is about Nvidia, Microsoft, or Tesla. Meanwhile, old economy payment stocks are seen as relics of the past. Yes, PayPal briefly popped when news came out they were working with OpenAI on integrated payments. But that move delivered only a brief 10 to 13% bump, and the stock quickly gave most of that back. Why? Because the market didn't see it as a fundamental change in PayPal's business. It was an event reaction, not a trend shift. So while PayPal is not dying, and it's not running out of cash, its story just doesn't fit the current market narrative. It's like a retired athlete, still capable, still healthy, but no longer the star of the show. Breaking down PayPal's business. Now that we understand why the valuation has been squeezed, let's look at what PayPal actually does. And it helps to think of the company as four engines: one that protects scale, one that captures youth engagement, another that preserves profitability, and one that drives high value services. First engine, brand checkout. This is PayPal's bread and butter. When you're shopping online and you see the PayPal button at checkout, that button represents trust and convenience. For many users, clicking PayPal means fewer forms to fill, fewer steps, and increased confidence. For merchants, placing that button can boost conversion and reduce cart abandonment. This segment earns PayPal its highest margin and is the cornerstone of its profitability. It's not selling a payment method, it's selling trust and certainty. And trust at checkout converts directly to revenue. Second engine, Braintree and PSP, low margin support. This is where many analysts misjudge PayPal. Braintree is the payment engine running behind big names like Uber and Airbnb. Unlike brand checkout, this business doesn't command high fees. It operates at very low margins precisely because the customers here have significant pricing power. So, why do this business at all? Because it anchors PayPal at massive scale, keeping the company in the game with the largest global merchants. But when low margin volume grows faster than high margin checkout, overall profitability looks worse on paper. Analysts see a fall in margins and think it's a problem. But in reality, PayPal is trading margin for scale and customer lock in, and that's building a moat, not destroying one. Third engine, Venmo, the young user engine. Many people still think of Venmo as just an app for splitting bills. That label is outdated. Venmo is evolving quickly. It's now enabling pay with Venmo on platforms like Amazon and Starbucks, Venmo debit cards, and consistent double digit revenue growth. Venmo isn't just popular, it's monetizing popularity. It's capturing the next generation of spenders, and this segment is becoming PayPal's second growth engine. If spun off on its own, Venmo's valuation would likely exceed what it adds to PayPal today. But as part of the whole, it's burdened by PayPal's overall average. Fourth engine, high value services, loans, and risk tools. This is the segment most people ignore, but it's actually hiding some of PayPal's highest profitability. This includes buy now, pay later, BNPL, consumer credit products, and merchant risk prevention tools. Each transaction here generates multiple revenue streams: the payment fee, interest from financing, and fees from risk services. These services are sticky, profitable, and growing quietly. They don't make headlines, but they add a thick layer of margin, putting it all together. When you step back from the noise, you see PayPal is not a dying company. It's a multi engine, mature platform. The question then becomes, is it a discounted cash machine worth buying or a stagnant legacy stock that will never recover? To answer that, we need to look at a few key metrics: valuation and cash strength. Right now, PayPal trades around 11 times earnings, a multiple more typical of a stable, slow growth financial company than a tech leader. Compare that to Visa and MasterCard at roughly 30 times, Adyen often above 40 times, and even private rivals like Stripe valued much higher. That tells you the market no longer treats PayPal as a high growth tech asset. Instead, it's seen as a steady cash generator. But look at the balance sheet. PayPal holds around $10.7 billion dollars in cash and equivalents against roughly $12.1 billion dollars of total liabilities. That means it could nearly cover its debt with cash alone. That's a position of strength, not desperation. And with that kind of liquidity, PayPal can weather economic storms or invest strategically without borrowing heavily. Shareholder returns. Management clearly thinks the stock is undervalued. They're buying back shares at a significant pace. That's like the CEO saying, "We think the stock is cheap, so we're putting our own capital behind it." Buybacks boost earnings per share and show confidence. Another often overlooked metric: PayPal's return on equity, ROE, hit 20% in 2024, a very healthy figure. This means the company is efficient at turning capital into profit without leverage. And in 2025, ROE grew further, showing underlying profitability remains strong even if headline growth slowed. So PayPal isn't scraping by using debt or gimmicks. It's turning cash into real returns. What could re-rate the stock? Low valuation and strong cash flows are great, but what could shift sentiment? Here are a few possibilities. Permez A, I integration and payments. If PayPal becomes the default payment layer for AI systems, say ChatGPT or future shopping bots, that would change the narrative. 2. Improving brand checkout margins. Higher conversion, better pricing power with merchants could lift profit margins. 3. Growth in value-added services. BNPL and risk tools growing faster would help overall profitability. 4. Continued buybacks. Reducing float could create valuation lift once the market notices. Right now, institutional ownership is over 80%. That means PayPal is highly institutionalized. Stocks like that tend not to spike quickly, but they also don't crater without reason. Some analysts are cautious, shifting to a wait and see stance rather than outright selling. This suggests short term surprises are unlikely. Long term, if sentiment improves, institutions could jump back in, pulling the stock up faster. So, should you buy PayPal? That depends on your style. If you're a short term momentum trader, this stock is likely not for you. It's not a weekly 50% mover like some AI breakout plays. There are many trapped holders above current levels, which can limit upside in the short run. But if you're looking for a stability oriented investment, a company with solid cash flows, a strong balance sheet, a diversified payment ecosystem, and shareholder returns via buybacks and dividends, then PayPal at these levels offers a margin of safety. It's like finding a dusty gold bar in a pile of rubble. It may not glint on first sight, but with patience and time, it can shine. If you like this video, don't forget to subscribe. I'm Lynn. See you next time.